Hello guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. New York. The US economy will need tight monetary policy for some time before inflation is under control, a fact that means slower growth, a weaker job market, and some pain for households and businesses. Federal Reserve Chair Jerome Powell said on Friday in remarks warning there is no quick cure for fast rising prices. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation. They will also bring some pain to households and businesses, Paul said in prepared remarks for a speech to the Jackson Hole Central Banking Conference in Wyoming. Market reactions. Chairman Paul spoke today at Jackson Hole where he mentioned and reiterated the hawkish stance the U.S. Federal Reserve is taking towards the current high levels of inflation. In a short and concise speech, he made several points. Firstly, that the economy was still showing strong underlying momentum and that the labor market in particular remains out of balance. Second, that interest rates will continue to rise to a restrictive stance and importantly stay there for some time, because the Fed views it will take time for inflationary forces to decline, but also because in previous inflationary episodes it was a mistake to relax policy too early. In short, the speech was hawkish and we would expect yields of government debt to continue to rise. Powell's short but direct speech was focused and delivering a message to the market reset expectations for a longer period of maintaining tighter monetary policy conditions in order to successfully combat inflation. He provided a historical context and justification for the need to maintain levels once the current cycle peak is reached and indicated the Fed's willingness to do so even in the face of a recession and rising unemployment. So, the headline summary is that we are getting closer to the peak, but we will plead for an extended period prior to any potential path downward. It was pretty much in line with what we're expecting, and that even though they don't want to give forward guidance, they are going to try and guide markets to the idea that they are going to slow down the pace of the hiking cycle, but they are going to offset that with the idea that rates are going to be restricted for longer, and that was what was stressed within the 12 statement that duration is now the preference, having a longer period of tighter monetary policy as opposed to you now concerning front-loading it at the expense of potentially having to cut rates in the future. I don't think market necessarily priced this correctly to begin with. This was a speech for his legacy because this Fed has been tarnished for its stubborn transitory view of rising inflation, which was exacerbated by a perception that Powell wouldn't be told now to do what's necessary to expel inflation from the economy. By invoking the work of the other Fed chairmen of Volcker who have had to deal with inflationary pressures, Powell made it clear how he wants to be perceived as a Fed chair who restored price stability in order to restore a strong economic foundations. Given to backdrop of easing financial conditions since early July, as we expected, we have seen a pushback by Fed Chair Jerome Powell on the market's assessment of an immediate pivot by warning against loosening policy sooner rather than later, which inflation has started to show signs of a turn. Some of the more resilient and present components remain elevated. The one sector which is showing signs of clear slowdown in activity is housing. Maybe that's all from me. Don't forget to like, comment, share, and subscribe. Thank you.